Welcome to your first time home buyer's guide. So in this video, I'm going to walk you through all the steps from beginning to end. So starting where you're at right now, likely renting, living with family, and then moving into your first home. And I'm going to show you the steps so that home buying doesn't have to be filled with anxiety, frustration, and overwhelm that it can often become. And the more you know about buying a house, the more that you understand how it works, the more money you're going to save, the more fun you're going to have, and the easier it will be for you to place an offer on a home that you like, and then be able to get that offer accepted and move in with the most ease, most joy possible. That's our goal. Okay, so let's go ahead and start with step one, which is planning your money. All right, and so you don't have a plan for how your money is going to work. How is this whole thing going to shake out? Then what's going to end up happening to you is you're going to be feeling like you're just getting tossed in the wind, and people will be able to sell you into programs or houses that you're going to feel like you didn't have control of the process at the very end. So you need to have a solid plan coming in at the beginning. So let's first figure out what you want to spend. Often people come in and they have no clue what they want to spend. They just let somebody else tell them what they're going to spend. So first, it's important to know the average contract date. So being under contract into when you first get under contract to closing and moving in your home is normally 30 days, could be 45 with VA. So planning is really important to make a smooth process. Know that a lender is not a financial planner. They're not interested in setting up something that works for your budget. So you have to determine that. A lender will often give you more loan, a bigger loan than you probably should take, and this is what's called being house poor. When your house payment is so expensive that you can't really do anything else with your money. And so we want to make sure that doesn't happen to you. This is why the plan is so important. Only you can decide your budget, and what we need to figure out is what are we going to spend monthly? And what are we going to spend as an upfront cost for down payment and closing costs, okay? So one quick way that you can do this is, I do have a tool. You can text me #MaxPrice, and I'll have it on the screen, to my phone number, which is 951-506-5744. And what that's going to do is send you a link to this calculator where you can put in your income, you can put in your debts, and it's going to tell you an estimated max purchase price amount. So let's figure out a monthly cost first. A good rule of thumb is no more than 25% of your take-home pay going towards a housing payment. You can also look at your rental expense if you're renting. So for instance, if your take-home pay though is $6,000, and this is net, this is after taxes, we can take that times 0.25%, and that gives us $1,500. So we know that our max payment right here, made of principal, interest, taxes, insurance, HOA costs, we don't want it to exceed that $1,500. Now you might be looking at $1,500 if this is your take-home pay, and say this is actually still too much for you. You ultimately have to figure out your budget and see what's comfortable. What can we spend per month right now? Right now, you're probably spending a certain amount for your rent. How much can you spend on a mortgage payment? What's the difference? How much more or less do you want it? And keep in mind, you also have utilities. You might have maintenance costs that go in there as well. Things that you need to be aware of, but 25% of take-home pay is a good rule of thumb that a lot of people will use. So we have the monthly cost, but then we also have an upfront cost as well. We have a down payment. We also have closing costs and some other upfront costs we have to be aware of when we're purchasing a home. So we do have the down payment first, and this is the biggest thing most people think about. Well, the down payment's actually a lot less than you might think it is. Some people think it's absolutely 20%. It's really not the case. Here are the 4 main types of loans, and you can see the minimum down payment with each. So for conventional loans, these are normally good if you have a 680 credit score or higher. The minimum is 3% down for first-time buyers. FHA is good for you if you have lower credit, some credit issues. It goes all the way down to 500 score for certain programs. You can do a 3.5% down payment. But so FHA is a little weird. If you have 500 to 579 credit score, it's 10% down. If you have 580 plus credit score, it's 3.5% down. And then there's USDA and VA. Both are 0 down, and they're a little bit, different. They have some restrictions. USDA is for rural areas and usually requires a moderate income. So there's an income limit there. And VA is only if you are a veteran. We have a lot of veterans in our area, so take advantage of it. So off the bat, that might mean lower than what you anticipated as well. So what you can do is you can take these numbers and multiply it times the purchase price. So you can take 3% times 500,000 as the purchase price, and so the down payment minimum is 15,000. On top of the down payment, you have closing costs, and closing costs are the fees that are required to close on a home. And they're charged by various different people, not just one person. Often people think it's just the lender. There's actually a lot of people in the transaction who are charging closing costs, and so an example of this would be an appraisal. That's going to cost money. The lender is also going to likely charge a fee. A title company is going to do a title search for your home, and they're going to charge a fee. The county is going to charge escrow. So I do have another video that goes into more detail on a buyer's net sheet. That's all the expenses on buying a home, and that dives deeper into those numbers. I will have a link below in the description, or maybe above. You'll also have taxes that you likely will pay to put into escrow account, insurance. So all of these things come together as closing costs. It's not just one fee. A lot of people think it's just this like random fee that somebody charges to make more money. It's really not the case. It's a bunch of people who are providing services during the transaction, and that's how they get paid, is through these closing costs. And this is going to vary widely based on the lender you choose and the service providers that you choose, and what taxes look like in your area or for that particular home. In our area, taxes vary widely. But 2 to 4% of the purchase price is going to be a good rule of thumb. Now, there are ways that you can negotiate for the seller to pay for some of those. Last year, that wouldn't have worked, but currently it could be an option because there's more homes available. Homes are staying on the market longer. We won't explore that right now, but this is a good rule of thumb. Then you also have your out-of-pocket costs. So an out-of-pocket cost that you would have to pay typically would be something like the home inspection. If you get a home inspection, technically it's not included in the closing costs, but you're probably going to run somewhere around $400 to $500 for a home inspection, and that's going to be paid after you get under contract up front directly to the inspector. So even if you don't close on the house, or if something falls through, you still had that cost that you paid. So it's important to keep that in mind and make sure you know about all these things, the down payment, closing costs, and out-of-pocket costs before you get started. Next, we want to transition into why. Why is one of the most important pieces of this planning puzzle, because what I like to think about a home buying is it's almost like you see this river and you put a toe in to see what the temperature's like, and we don't realize that there was a huge current right beneath and it sweeps you away. And so for a lot of people, that's what happens with home buying. It's like I'll dip a toe in the water and they don't realize they get caught up in it. And if you're not extremely clear on why you're purchasing a home, it's so easy to end up downstream floundering and you're not able to come up. So you're clear on why you are buying a home. Is this a necessity? Do you have to buy a home within a certain time period? Great, that's your why. Or is this something I want to do? I want to stop renting as a reason. I want to get into buying a home. But it's not a necessity. I don't need to do it and I don't have as much urgency. This is going to help make sure that you don't get caught up into deals that you're not comfortable with. And you can recognize, you know what my why was more of a preference, and so I can step out of the housing market if I need to. So what I want you to do is I want you to create a Google Drive account. It's very simple. All you have to do is go to drive.google.com. It's free, and I want you to set up a little note, a file, like a little Word document, and put it in your Google Drive folder, okay? I just called mine Buying a Home. You can call it whatever you want. Put it into a Google Drive file, and I just want you to start typing out, why are you buying a home? And so you're going to recognize in these slides this little Google logo drive, and anytime you see that, that's something I want you to put in your Google Drive, because you're going to be assembling all these documents together. It's gonna help you, it's gonna help with clarity. Clarity helps you make wise decisions. Moving forward, if you don't have this plan, if you don't have this prep, if you don't have the clarity, everything's gonna feel disheveled and overwhelming. So you're gonna be frustrated, stressed, and anxious through the process, and that's not what we want you to have. I want you to feel joy. I want you to feel momentum as you're moving through this and feeling like this is exactly where I wanted to be. And you won't get there unless you have that clarity. So now let's move on to finding a lender. So we need to find a lender first before we start searching for homes, before we talk with a realtor. And the reason why we need to do this is because, number one, we need to know that we can get a loan. There's no point in us going to see homes, writing offers, getting attached to something, and then figuring out, actually, there's this thing keeping us from buying a house. And that's why we need to talk to a lender first. If there's credit issues, we also have services that can help with that. Also, we need to figure out a maximum amount of how much we're approved for. What is our max purchase price? We don't want to go looking for $600,000 houses if we're only approved for houses that are $500,000 or less. So we need to know exactly what those numbers look like first. So this is who you can work with. There are three main types of lenders that you can work with. Number one would be a mortgage broker. Then you can look at a local bank or a credit union or a big lender or online lender. Don't recommend so much the online lenders. So I'll explain these three, and what I want you to do is I actually want you to apply to all three of these lenders here, because these will give you different types of lending institutions to see which one is going to be a better fit for you moving forward. So they all have different cost structures. They both will have different rates and different costs as well, and different styles of running business that might change who you enjoy working with. So check out all three types. I have a lender I like working with that I could recommend, and it's not because I get a referral or a kickback. That's illegal. It's because he knows his stuff, and if he says you're approved, your loan will go through and you will close. No surprises down the road. I have had some nightmare situations that buyers have gotten into because they found a lender that they think are giving them a great deal, but they don't have anyone that has worked with them before, so they're not sure. There is a saying I have learned that if it looks too good to be true, it probably isn't true, and you should avoid falling into that trap. So here is where you can find these lenders. So you can come through me, like I do referrals across the nation for both lenders and real estate agents. And so that link is in the description if you want as well. Zillow is also an option. Zillow has a place you can search for lenders, and they also have their own lender, which is kind of sketchy these days. You can search for lenders on Google. That's also an option. See what the reviews look like. You can get a referral from your real estate agent, such as myself. Often real estate agents like working with certain lenders. I went over that before on why. It's illegal for them to have kickbacks or any kind where there's an exchange of value, but often it's really helpful when your agent and your lender work together because they know the loan's going to go through. And you could also get a referral from a friend. Ask a friend who just bought a home. Hey, who did you work with? Did you like them? Did you not like them? Let me know what their contact info is. So at this point, you're probably wondering, what's my rate? What rate can I get? A really easy way for you to figure this out before you talk with the lender, that way you can just set up your expectations properly, is Googling Cfpb rate checker. It's going to take you to this website where you can put in your credit score, you state your estimated price, estimated down payment. You can guess on all this stuff, put in your estimated loan, and see what kind of rates are being offered most in your area. I think it's really good to have this before you actually talk with a lender, because a lot of people talk with a lender just to get the rate. And it's kind of bad use of both people's time. It's easy to figure out an idea of a ballpark of what your rate would be. Okay, so when we talk with the lender, we want to get down into some details, more about what we can qualify for. What are some of the ways that we can save money with our mortgage? Okay, they're experts at that. My guy is going to give you lots of options. Those are more interesting conversations, just more than just what is the rate. So now let's move on to getting pre-approved. At this point, we would have found a lender through one of those sources. Ideally, we would have found three. We would have found a broker, a credit union, and a direct lender. And now we actually want to get pre-approved with those lenders. So what's the point? What is the point in getting pre-approved? Number one, we can see what type of loan we're going to be able to get approved for. Again, I talked about conventional, FHA, USDA, VA. There's also a portfolio. There's non-QM, there's jumbo, there's ARM. So there are all different kinds of loans, and you don't have to figure out what loan you can get, but your lender, your loan officer is going to help you figure that out. So we first want to see what type of loan we're going to be using, because that's going to be critical to the offer. We need that when we place that offer on a home. We have to tell the seller, are we using conventional financing? Is it FHA? We're also going to tell us our max purchase price. So what is the limit that we can go for when we're shopping for a home? That way we're not searching again for a $500,000 home when we're only approved for $400,000. It's going to tell us what our interest rate is. It'll tell us our down payment requirements, what costs the lender will charge. And then the lender will also estimate the other fees, those things like taxes, title, insurance, recording, appraisal. They'll help us estimate those fees. So ultimately, we can see what the bottom line number might be for us. This is called a good faith estimate. Now at this point, what I want you to do, again, we haven't talked to any of these people yet. We've just researched them. We have a list of people who we want to talk to. Now I want you to get together your documents, and a lot of people mess this up, okay? And get all confused when the lender makes the request. They talk to the lender, and the lender is like, okay, send me the documents. It just extends the process too long if you don't have that ready. Get your documents together now before you talk with the lender. You're going to come in as like this golden borrower who everyone wants to work with because you're prepared. And the process, again, is going to be so much easier for you if you follow the steps this way. So the documents I want you to get together, this is going to work for most people. Likely there's going to be some other documents for your lender that he'll request of you, but this is going to be a good place to get started for most people. So again, in your Google Drive folder, create a folder that just says, here are my mortgage docs, loan docs, or whatever. 30 days pay stubs, 2 years of your W-2s or your 1099s, and you can ask your human resources for this if you're not sure where they're at, or ask whoever has been paying you for contract work your 1099. You're going to need past 2 years of tax returns, past 2 months of bank statements. You'll be using for your down payment and closing costs. They don't need to see all your bank accounts, just whatever has money in there for your down payment and closing costs. And then also your driver's license. Put those all together in one Google Drive folder, and then you can share that with each lender. It makes it just so much easier. They'll be able to give you an accurate pre-approval, accurate quotes, and go through the process a lot smoother. And so it's going to look something like this. Just keep it all in one place. And now you have a little folder here. I can use, click this arrow over here to share it with a loan officer, and you can send it via email. So that process can get started again a lot quicker, and it's a lot easier. So here is what you can expect. You're going to apply with each lender, and now some of them you might have to call to get the link. Some of them might have a link on their website where you can directly apply. It's just going to change, but it's probably going to take you around 15 minutes each to be able to go through these applications. Shouldn't take too long, so I would carve out about 45 minutes to an hour, just knock through those applications and get all the information submitted. It really is not too difficult. It's just like general information. So here's what some of the questions might be, like, where do you work? What's your employer's name? What's the address? Where have you lived over the past 2 years? How much money do you make? Just some basic questions. How much money is in your bank accounts? Have you had bankruptcies? Have you had foreclosures? Again, it's general questions like that. It's really not too difficult, I promise you. So they're gonna do that. They're gonna also do a credit pull. And a credit pull is important to getting an accurate score. If a lender does not do a credit pull, and they give you an interest rate, it's not accurate. You need to have a credit pull, a hard credit inquiry. And you can't give them Credit Karma's information, it's different. So it's important to remember a credit inquiry is only going to change your score anywhere from 0 to 5 points, and it's not going to tank your credit score. Also, you have a 45-day window where you can get your mortgage credit pulled. Your mortgage credit pulled an unlimited amount of times, and it will only count as one inquiry. So I promise you, if you have 3 people do a hard pull on your credit score, it will only change your score 0 to 5 points. It's not going to tank your credit score. You may have something from Credit Karma, like I said, that acts like the sky is falling, but just know that's not actually tied to your real credit score that a mortgage lender is going to pull. It's actually called a FICO score. So after they do that, you're going to send them the documents that you had from your Google Drive. Super easy, huh? Share it with their email. Now they have that Google Drive with all the information. They have all your documents ready to go. Then after that, they should be giving you a full quote. And what I mean by a full quote is it needs to tell us the rate, the monthly payment, all the costs. I want their closing costs, and I want all the estimated closing costs to give me a bottom line number. That way, you can see exactly what it's going to cost estimated with lender A, B, and C. Take all of those quotes, put them into Google Drive. That way you have them to be able to look back again. They're assembling this little folder together. You have all your information. Again, clarity helps you make wise decisions. Moving forward, they're also going to send you a pre-approval letter. And this pre-approval letter is something that you'll end up giving to your agent. We need that. They'll put it in with your offer, and it's going to help you stand out to say, hey, I actually have the ability to purchase this home. I have the funds to purchase this home because I have this pre-approval. So put it into your Google Drive so you have that as well. So we have these 3 loan offers. Now we need to actually compare them and see which is going to be the best lender to work with. So what I would do is I would ask each lender for what's called a good faith loan estimate. It's a standardized document. A good faith loan estimate is an official document that every single lender across the nation is legally required to give you within 3 days of you being under contract. However, you can ask for this before you're under contract. Just say, can I have a good faith loan estimate? And the reason you want this is because when these lenders give you these 3 quotes, they're going to be on different documents, different forms. It's going to be hard for you to sort through and see side by side. What are you comparing side by side? So the good faith estimate is a good way to compare all these, because all of their documents are going to look different from each other, and having them on a loan estimate standardizes exactly where those fees are. So if you go to this link below, I'll have in the description as well, there's a little loan estimate explainer tool. It's kind of an interactive, and you can explore a loan estimate. This is what the loan estimate looks like. It's going to be these 3 pages of importance that you want to look at. So page 1 of the loan estimate is going to tell you just some important highlight information. And so I know it's small, but go to the loan estimate explainer. It's going to help you see this a little bit more clearly. So it's going to show you things like the purchase price, the loan amount, the interest rate, the monthly principal and interest payment. It's also going to show you, is this a 30-year loan? Is it a fixed rate or an ARM? What type of financing is it? Conventional? Is it FHA? Is it VA? Is it USDA? This is also going to show you things like, does it have any what are considered dangerous features? Prepayment penalty. Does it have a balloon payment? Ideally, we want these both to say no. It's also going to show us, is there mortgage insurance? If so, what year does it fall off? What's the APR of this loan as well? So we can see all these numbers side by side when they're all on loan estimates. So request the good faith loan estimate, put those bad boys in your Google Drive, and that way you have them to be able to look at in the future. So now when you're deciding at this point, you don't have to make an official decision and say, I want to work with lender B. However, we're probably going to get an inclination of what lender is going to be best to work with. That way, when we're under contract, you kind of already have an idea of what lender you do want to work with. And so what I would do is I'd put together these two pieces of figuring out who has the lowest cost offer. And when we're figuring out the lowest cost, we're trying to figure out this trade-off between rates and the cost as well. You might have one lender that gives you a 3% rate and costs me $1,000 in lender fees, and another one who charges 3.5% interest rates, but there's no fees. And so which one is better? Which one do you want? So a combination of low cost and gut feeling as well should work. Because you might have a lender who gives you this crazy low quote, but they don't respond to you. They're not very helpful. They're kind of rude. If they're difficult to work with right now, if you don't have a good feeling about working with a lender right now, it's going to not be a good time when you're under contract. Same thing if you're shopping for clothes. If you don't love it in the store, you will hate it everywhere else. I promise you. So make sure that you're working with somebody that you really enjoy, somebody who has the heart of a teacher, who's willing to explain things to you, who is able to respond to you in a timely manner, and has low cost as well. That's going to give you your best option. Something to keep in mind here at this point, you've been pre-approved, some big don'ts that you don't want to do. You don't want to make any big movements with your money, so don't make any major purchases, especially with new credit. Don't go buy a new car. Don't go finance furniture. Don't do any of that. If you have to do anything like that, talk to your loan officer first, or even better, do it after you close. Don't change or quit your job. One time I had somebody who was like, hey, I just got a new job and I got a pay raise. And I was like, no, we have to start the whole thing over again. We have to redo the pre-approval, even if it's a new job that pays more money. So talk to your loan officer if you're going to do something like that, because it can change if you're pre-approved or not. Don't move large amounts of money in or out of accounts. That can be really difficult for now that the lender have to track. Don't pay off debts or collections. That can actually lower your credit score if you do it incorrectly. And don't make late payments. Still, pay everything on time. Sometimes I hear realtors or other people saying like, yeah, you can skip a payment on something. No, never. Make the payment. Make the payment. Don't make late payments. That can completely derail you from being able to get a home. Now let's move on to finding a real estate agent. So here's some guidelines you want to keep in mind. Don't use a dual agent. Don't use the agent who is listing the property, because if they represent the seller, how are they going to represent you as well at the same time? Explain your scenario to an agent and see how they respond. We're looking for somebody who has the heart of a teacher, who's willing to explain things to us. And there's a difference that you'll pick up between being helpful or being salesy. You'll be able to pick it up super quick to see which agent you want to work with. Hopefully it's us. We meet those criteria. And experience isn't everything. Agents often will do this thing of, I've been in the industry for 30 years, and who cares if you're not helpful? If you're not good at your job, it doesn't matter how long you've been in the industry. Length, that doesn't determine how helpful you are, how much you succeed at helping homebuyers get what they want. So experience isn't everything, or top performers, sometimes they're too busy to work with a buyer. And ultimately, trust your gut. Again, as you're talking with some different agents, you're gonna find somebody who you like working with. Maybe the first person you talk to, you really enjoy. Great, you don't have to go shop a bunch of different agents and interview a bunch of agents. You can if you'd like, but if you find somebody who you really click with, great, let's work with them. And then where do you find them? We have helped many buyers such as yourself, whether you are a first-time buyer or an investor, and we would love to help you. It's important to keep in mind that your agent is usually going to be paid by the seller. So there's usually no cost in working with a buyer's agent, or no upfront costs that a buyer has working with a real estate agent. So get the best you can. So you have your agent, you've been pre-approved. Now it's time to actually start shopping for some homes. So here's some big do's to keep in mind. Number one is follow your agent's MLS updates. I know the apps are really nice to use. Zillow has a fantastic app. There's Realtor.com has a great app. We also have a great app that is tied to our website that gets its information directly from the MLS feed and is about as up to date as you can get. Some of these other apps are not updated regularly and have old, outdated listings on them. They look nice, but their data can be old and not up to date. Your real estate agent is going to be connected to a database called the MLS. That's Multiple Listing Service. That's going to have updated information as accurate as it is possibly. That can be listings that hit the market. And so when you're competing for homes with other people, you want to be the first person to hear about a new home that gets listed. That way you can ideally go see the home first and put in an offer first. So follow those updates and stick to your lender's max price limit. If the lender says, hey, you're approved for up to $350,000, don't look at $400,000 houses. You're not going to be able to get it unless you go back to your lender and say, is there any way we can raise this? Don't look at above what you're approved for. It's just going to set you up for emotional disappointment. Moving forward, also stick to your monthly budget. You can talk with your lender and say, hey, I want to stay under $2,000 a month payment, a $1,500 a month payment. Where do I need to be in my price range? Where do I need to look within that range? That way you can stick to it. Again, don't go find this home, fall in love with it, and then realize there's no way that I'm actually going to be able to afford this monthly. And then use your whys to set up a timeline and urgency. If this is something, if you have to purchase a home for whatever logistic reason, that means that if the home doesn't have everything that I want in it, I still might need to make a move on it. On the opposite side though, if a home is more of a want at this time, something like I want to do but it's not urgent, don't go make huge, drastic, urgent moves when you don't have to. Don't commit to a home. Take some patience. Wait for the right thing to come along, and then also make a needs versus wants list. Open up a file on your Google Drive and call it needs versus wants. Write down what is an absolute need, things that I absolutely need to live in this home versus what I want. Make sure that you're very clear on what those are. That way, when you're shopping for a home, again, you don't get pulled down the stream just because the current was fast in the housing market. Because I'm telling you, when you start searching for homes, it's gonna move quick. You're all of a sudden gonna hear someone place an offer, and there's multiple offers, and you're gonna feel like you have to make a move on it. If you're not clear, you're going to make a decision that you may regret in the future. If you move too fast, if you move outside of your why, if you move outside of your budget, most important. Some don'ts. Don't get emotionally attached. I tell all my buyers, I know you see this home, and part of it figuring out if a home is right for you is picturing, do I want to live here? But in that, we get a little bit too emotionally attached, and we can't get emotionally attached until we close on the home, because things can fall apart. And we just need to make sure that we prepare ourselves for this. We can have excitement about a house, but at the same time say, you know what? I'm going to wait a little bit longer before I let emotional weight of this all land on me. Also, don't move too fast or too slow to schedule showings depending upon the market and your why. Again, go back to your why. Don't make urgent moves if you don't have to be urgent. If you have the ability to wait and something, it's like 50% of what you want, great, let's hold out a little bit longer. It's not unreasonable to move forward with a home that has 75-80% of what you want, and that you can make updates to and make it your own down the road. You don't have to go write an offer on this home and then potentially regret it in the future. Also, don't feel like you need to see every home. I know in the beginning it can be tempting to be like, sure, let's go line up a list of 20 homes, go see. I talk with agents sometimes who they'll be like, yeah, I went and showed, I've shown this person over 50 homes. Like, you don't have to see all those homes. With great information and pictures online, narrow down your selection to 5 or 6 best that meet your requirements. People who see that many homes are not clear on their why. They don't have needs versus a want list, and they don't have a budget. They're not clear, and it's a waste of time. Think of all the time that you're wasting seeing these homes that, you know, I can look online to see generally most if I'm going to be interested in a home or not. So make sure you're very clear on that to save yourself time. Now into writing an offer. So you found a home that you like. Now you actually want to write an offer on it to say, hey seller, we'd love to purchase this home on these terms and see if they accept it or not. So you can negotiate what you want. And this is more than price. It's not just, hey, you offered it for $500, I will give you $490 for it. What you can also negotiate is how long is the contract? How quickly do you want to close on that home? What type of financing you use? Is it going to be included in your contract? If the seller is going to give you any credit towards your closing costs, that's something you can negotiate. You can negotiate things like inspection periods, how long you have to inspect the home, and if you ask for repairs. If you are willing to pay above the appraised cost, yeah, above the appraised value if it comes in low. In the past 2 years, that was standard. There's all these things that you can negotiate. Sometimes you can even include personal items, so talk with your realtor about the logistics of that as well. So you put in an offer to the seller, and the seller often will accept or counter your offer. So if they accept it, great, you move forward with that offer that you presented. If they counter, they might come back and say, well, actually, we'll do this contract, but instead of doing the $3,000 closing cost credit, we want to do 0 closing cost credit. And then you can come back and choose to accept that or not. So if it's accepted, that contract becomes binding. It's the map of the transaction, and sometimes it's people that can forget this is a legal binding contract that you have to follow. There's timelines involved. We use the contract as a map to determine the dates when things get done and how they get done. So keep in mind that when you're putting in an offer, it's not just like a serious thing. I hear people talking about practice offers. Putting into practice offer? No, it is a real offer. Somebody can accept it, and then we're legally bound to those terms. So be very careful about what you're doing and what you're actually committing yourself to in these contracts. So some tips. Write an offer that helps you win. In other words, put your best foot forward. If you really want to win this house, especially in a competitive market, don't act like you don't want the house. If you're dating somebody or you're in a relationship and you like the person, you're not going to benefit if you sit back and be like, yeah, I kind of like you. How is that going to progress a relationship for it? You tell somebody, you communicate with them, hey, I like spending time with you. That's what progresses a relationship forward. Same thing when you're writing an offer. If you're interested in it, communicate your interest through the offer. So often I see people who are like, I really want the house, but I'm going to lowball them by $25,000. And then they don't get the house, and then they're really upset. There's a disconnect here. If you want the house, communicate that with your offer because you want the seller to accept your offer. That's how you get the house. So make sure that you do that. Communicate your interest with your offer. Ask your agent how you can make the offer more competitive, because there might be little things that you can do in your contract, things like shortening contingency dates, shortening how long you have for your inspection, shortening how long the contract is, changing things like your home warranty to be able to make your offer just a little bit more attractive than the other offers the seller might be seeing. Also, consider a compliant offer letter and put it into your Google Drive. So an offer letter is basically where you're writing, some people call these love letter or something like that. You're writing a letter to the seller, communicating why you want to purchase the home, how much you want to purchase the home. And it's important with fair housing regulations, talk to your agent about this. I've had good success with this. This first, and make sure that there are no fair housing violations in there. So likely you're going to have to stay away from anything that involves anything personal attributes about you. Mostly you're going to have to stick with details about the home itself. So talk with your agent about the compliance with that. And then here's a big one. Ask your lender to call the listing agent. Often sellers or listing agents will get multiple offers coming in, and a big question the seller has is, if we go with one of these offers, we really want to make sure it doesn't fall through, that the financing doesn't fall through, because that's the thing that can happen. If your lender then calls a listing agent or the seller, if it's a for sale by owner, and can communicate, obviously they're not sharing personal details about your finances, but they communicate and they can say, hey, we have all the documents, we have a full pre-approval, and we've checked that everything is good to go. This person is solid on their financing. Your offer is going to stand out way more than all the other offers that didn't have their lender call at all. Now we want to get a home inspection. So we got under contract, the seller accepted our offer, and now we need to make sure that the home is stable and in good condition for us moving forward. So what will happen is a certified home inspector is going to examine the home to identify any issues to bring to your attention. I will typically provide at least 3 different home inspection companies that you can choose, which one you feel most comfortable with. You can use the brother-in-law who is handy, but for the contract it will be like there was no inspection. It will also be very difficult to ask for requests for repairs from the seller if you choose this route. I don't recommend this choice for home inspection unless you're not going to ask for any repairs at all. They'll then prepare an inspection report. And again, I want you to take that inspection report, put it into your Google Drive. So on that inspection report is going to detail things that need improvement on the home. And often a good inspector is going to produce a report that almost makes it feel like the sky's falling. And it's going to seem like there's a lot of issues. And often there is a lot of issues, but they're small things. Keep in mind, new homes have just a bunch of things that need work. Homes always are going to have some little bits of work done. Don't get scared by small things. The main purpose of the inspection is to identify problems with the major components in the home, not a paint chip. What you're looking for are these big issues that could cost you thousands of dollars in the future. Little things that only take a drive down to Home Depot and 30 bucks to fix are not things that we're willing to kill a deal over. The things that we're willing to kill a deal over are maybe huge roof problems that we don't have the money for or the capacity for right now. So your contract will determine if and when you can negotiate repairs to be fixed by the seller. Keep in mind that all California purchase contracts are written as is condition. You have the right to request for repairs, and we do that via the request for repair document. But the seller does not have to agree. So you get this inspection report back, and likely in your contract you have an inspection contingency period where basically you get to, if you find issues, you may be able to ask the seller to fix those things, or you may be fine with them moving forward. I always recommend getting a professional repair quote on a repair just so you make sure it's something you can cover down the road. Or you may walk out of a deal at that point if the seller is not willing to make major repairs. In a home inspection, this is a big moment of change because buyers can back out, they can request repairs or concessions as money instead of repairs. They can renegotiate the terms of the contract. This is a big point where deals can kind of die or change based on how the inspection report came back. So then we move into the underwriting process. All right, so here is how the underwriting process works. So your lender and your loan officer is going to take your pre-approval and they're going to work on finalizing it into a full approval. So likely they had most of the documents that they needed, most of the information, but they'll probably need to button it up with just a little bit more information, so don't be surprised if they ask again. So they want to make sure that you can pay back the loan by examining and documenting the risk of the loan. That's the whole point of the underwriting process. It's the lender is about to give you probably several $100,000. Put yourself in their shoes. If you're going to give your friend, like, would you loan your friend 50 bucks? I know some of my friends, I definitely would. So if you're lending somebody hundreds of thousands of dollars, wouldn't you want to check to make sure they have the ability to pay it back? That way they don't go off with your several $100,000 and default on it. That's what the lender's doing. They also have a legal obligation to make sure that they're giving you a loan that's non-predatory based on government regulations. So that's what they're doing here. We had lots of problems back in 2008 with predatory loans. They're going to ask for a lot of information. Just expect it, just roll with it. It's not fun. They're not picking on you. It's just part of the guidelines. So through this process, you're probably going to be either talking to your loan officer, or they may have a processor who's helping you navigate and collect those documents as well. So when they ask you for information, it's important to give it to them as quickly as you possibly can. So what they're going to do is they're going to take your pre-approval, all that information, send it to an underwriter, and the underwriter will then come back with a conditional approval. And the conditional approval, they're likely going to kind of say, hey, congratulations, your loan's been approved. And then they'll probably say, please send us the following documents. And it's all going to be situation-based. But I have some examples of what they may come back in a conditional approval and ask again. And again, this is where you had most of the information in the pre-approval, but the conditional approval is basically saying, hey, to close the loan, get a final clear to close, we still need a couple of other things. For some people, they don't need to send in anything. For others, there might be quite a few documents depending upon how complex your loan is. So for instance, they might say something like, hey, we need page 3 of the bank statement. Maybe that was missing because they need the full statement. When you send it in, they need evidence of homeowners insurance. So they need to see that you have a homeowners insurance declaration page that you went out and got, and maybe they want a letter of explanation for something that showed up on your credit report, or hey, they saw 123 Main Street come up on your report. Maybe that was a past address you lived at, and so I keep hitting this letter, a lot of explanation says, hey, I used to live at this property, but I no longer live at this property. Sign it, and that's it. Send it back. Maybe the most recent pay stub, because one of yours expired because they need a certain period of time. And then maybe they also ask for, hey, send us the contact for your human resources or your manager so we can do a verification of employment. So it'll be things like that. And then they may do that verification of employment right before you do the loan docs. Sometimes a conditional approval can come back and you can be like, oh my gosh, I didn't know my loan was going to fall apart. And it's not the case. Conditional approval, everyone's going to have a conditional approval. So it's the most normal thing. Just expect it. All you need to do is collect those documents and send them back to the lender. You also want to get homeowners insurance at this stage, and homeowners insurance is going to cover things like fire, natural disaster, and things like that. Take your homeowners insurance declaration page, put it into your Google Drive folder again, assemble it all together. Clarity helps make wide decisions moving forward. You can shop for your insurance coverage to find out what works for you. So again, maybe you're Googling, you can look online, I guess that's Google, that's fine. You can ask friends, you can go with whoever your current car insurance. That's a good thing because you'll get a discount on everything. You can go ahead and shop for multiple quotes for insurance. So your insurance quote most of the time is going to be included in your mortgage payment. So insurance is normally given as an annual amount, and the lender will then pay that for you, but they'll charge you monthly and then they'll pay your insurance company annually. They'll kind of put it all together in one account for you, and then they'll pay the insurance company. Also, what a lot of people don't realize is your first full year of homeowners insurance is paid up front. And so this is included in your closing costs. It should be included in your loan estimates. 12 months of homeowners insurance inside of the prepaid section. And it can be a little confusing because they're collecting 12 months up front, prepaying the first full year, and then they're also going to collect monthly in an escrow account. And so you sell the home within that period of time, you'll get escrow account money back when you close. Any money that's sitting inside of an escrow account, if you sell a refund, will be issued, you get back. But an escrow account is basically where the lender is taking these bigger payments like annual homeowners insurance or semi-annual taxes. Instead of you paying those once a year, the lender will collect it monthly, store it in an account, and then they'll pay it for you. And that's peace of mind that you know those things are taken care of. So now, at this point, the lender is going to order an appraisal. And an appraisal helps the lender see how much is the home worth based on what should be an unopinionated party's value. Because the seller obviously wants the most money and you want the lowest amount of money to pay for it. We want to get a third party in there to see what the real value is. That way the lender can see, are they willing to loan you this much money? Because this is what happened in the housing crashes. People were getting loans for homes like loans were way more than a home was actually worth. And so if you're purchasing a $500,000 house, the lender doesn't want to give you a $550,000 loan because the home is not worth that. So that's what the appraisal does. The appraisal is mainly for and ordered by the lender. Now it kind of has the other benefit of like, it also can help out the buyer see what the value is. But the appraisal is primarily for the lender. So that's the whole point. It's so the lender can make sure that they're not giving out too much money. So ideally the appraisal value will be at or above the purchase price. If it comes in lower than the purchase price, is where often we run into issues where contracts either die or they need to be renegotiated. So the lender is going to use the lesser of the purchase price or the appraised value to determine your loan amount. So if we're going back to 3% down conventional, it's going to be based on either the purchase price or the appraised value if it's lower. It's going to be based off the lower appraised value. So what will happen is the appraisal inspection is scheduled, and then once the appraisal's done, the report is going to be given to you, likely by your lender. And again, throw that in your Google Drive so you have it all in one place. So let's run through an example of what an appraisal would look like. So let's say we have a home and we go under contract to purchase it for $450,000. Perfect. We get an appraisal done and it actually comes in at $457,000. Awesome, $7,000 higher than what we expected. So theoretically, we're purchasing this home at a $7,000 discount. Now, the purchase price doesn't raise up to the additional $7,000. We don't let the seller know if the value went higher typically. We got to purchase the home kind of at a discount according to the appraiser. So the transaction price is $450,000. We continue with that. We sign a contract at $450,000, the seller signed at $450,000, great, and the loan amount is going to be based on that. Now let's run into a scenario 2. Same thing, we go under contract to purchase a home at $450,000, but the appraised value comes in at $445,000. It's actually $5,000 lower. We ran into an issue here because we agreed to purchase at $450,000. That's what the lender's numbers are based on. However, the lender's not going to give us more than, they're not going to allow us to have a technical purchase price above $445,000. So now we have to figure out, how do we make up the other $5,000? Because again, the loan amount is based off the lower amount, $445,000. So we did 3% down on $445,000. Now the other $5,000 has to come from somewhere. So what happens at this point is the appraisal contingency in the contract may kick in, and we could get a chance to renegotiate the contract. Over the past 2 years, that didn't happen. Homes were typically selling at 104% of list price. So the lender is only going to give us a loan based off of $445,000. So either we have to come up with $5,000, the seller has to come down $5,000, or we split it in the middle. So this is where it can be renegotiated if that's allowed in your contract, and most are. So now, just before closing, we did the pre-approval, we got the conditional approval, we did the home inspection, we did the appraisal, that all came back fine. We send all those documents and now we're clear to close. So when we're clear to close, everything is finalized with the loan. The inspection came back fine, we negotiated that the way we wanted to, the appraisal came back fine in this instance, we sent in all the documents that we needed to, and the lender is basically saying, hey, take a breath, you're done. It's the best feeling, believe me. You're done with the loan, no more stress about the loan, and so what they'll do is they'll send you a closing disclosure, and the closing disclosure is very similar to a loan estimate. It just ends up being the final version, the loan estimate. In the word, it's an estimate, or the title, it's an estimate. It can fluctuate depending upon what's changed in the transaction. Closing disclosure should be locked down and finalized here for you. No more changes. And they'll also send you how to actually send money to the escrow company most of the time. So either it's a wire transfer or a cashier's check. They'll help you navigate how you're sending the money and who you're sending it to. It's very important. And then when the closing is scheduled, so just before closing, what you're going to be doing is likely a final walkthrough, and this is going to be negotiated in your contract at the very beginning. And again, we talked about the contract is the map, and the contract you see has been guiding a lot of these things going on about the inspection, about the appraisal, about the walkthrough. And so that contract is very important to understand what you're signing for, because it will determine the course of the transaction as you go through. The final walkthrough is typically 4 to 5 days before it actually closes. So you're likely doing the walkthrough to see the condition of the home, likely to see is the seller still living there, because maybe that's negotiated as well. And then also you want to review your closing disclosure and compare it to your loan estimate. Again, put that in Google Drive. And that's why I want you to put your loan estimates in Google Drive, is because now you have an easy way for you to go look at it, compare those two side by side and see what changed. Likely there will be some changes because the loan estimate was just as it states, an estimate. But you should be very, very close to your closing disclosure. There shouldn't be this huge discrepancy, and if you see these changes, maybe it's okay. They quoted my homeowners insurance at $1,000 a year, but it came in actually at $1,200 a year. Well, it's not the lender's fault, and there was a change. That's your homeowners insurance quote. It came up $200 more. Okay, that makes sense. So that helps you understand what's changing between these two documents so you're not caught off guard. Then at closing, so what will happen is closing will be scheduled. So kind of in post-COVID world, things have changed a little bit, but often this is referred to as the closing. This is all going to depend on what's customary in your area. For instance, in my area here, it's very common for closing to occur at an escrow company, and on closing date, neither the buyer nor the seller or the agents need to be there. All funds and required documents have been previously signed remotely or at the escrow company. We just wait for the loan to fund into escrow, the official county recording of the deeds, and it's done. In other areas, it's very common for a closing to get scheduled, and everyone kind of comes around the closing table. So the buyer is there, the seller is there, both agents are there. There's usually a title company rep working, possibly attorney, helping you actually sign closing documents. And everyone kind of comes together and puts the money that's needed. Here's the money, and then we get the keys back and occupancy and sign final documents. But this may be done differently depending upon what your lender does or what's customary in your area. So review all the documents and ask questions. Don't feel like you're being a pain, like it's probably frustrating to see that stack of documents and be like, oh my gosh, I'm gonna have to read through that whole thing. Your lender likely will send you a copy of the loan docs beforehand so you can kind of review it. But if you're looking at a document and you're like, I have no idea what this is, don't go signing documents that you don't know and you're not comfortable with. Make sure you understand, ask questions. If you need to, don't sign a bunch of things and then afterwards be like, I really, really wish I understood what I just signed. You're gonna get a copy of all your closing documents. Throw it in Google Drive. That way you have it to reference if you need it later. And then keys and the occupancy of the home will be exchanged according to your contract. Again, this is why the contract is important. Sometimes at closing, they'll hand you the keys, and that's not in our area. And you're going to be able to go, you can go drive to the home and move in right then and there if you want. In our area, the buyer's agent will typically meet you at the house with the keys after the official recording of the transfer with the county. Sometimes maybe you negotiated for the seller to they have the weekend to move out, or they have a week to move out. That can all be negotiated inside of your contract. So after closing's done, first payment and beyond, first payment is usually due in over 30 days. So normally it's going to be the end of the month plus an additional month before your first payment is due. In your closing package, all those documents that you're signed, it's going to spell out how you're making that first payment. Either likelihoods, you're sending a check to there, be instructions for how to set up an online account if you want to do that. Your principal and interest payment is not going to change if this is a fixed rate loan. So it's always going to remain the same, and that number was on page 1 of the loan estimate. However, what will change, again, this was on page 1 of the loan estimate as well, is your escrow taxes and insurance. If taxes change, if your taxes go up, your mortgage payment will go up as well. If your insurance goes up, your mortgage payment will go up as well, because taxes and insurance are included in your mortgage payment. So if you see a fluctuation there over the years, that's likely what's changing. Principal and interest will not change over the entire duration of the loan as long as it's a fixed rate loan. So pay attention to your escrow account. Your lender is going to be sending you details about what's in your escrow account, what's changing with taxes and insurance, so you can be aware and up to date of those items. Hopefully this process wasn't super overwhelming at this point, or just learning about it. And maybe it was, and if so, that's okay. When you're kind of getting into something new, something that feels new, it can feel overwhelming at first. But I hope this helped give you some more clarity and understanding a little bit more about what's going on, because I promise you, just by watching this video, you're more prepared than 90% of other home buyers. And the more prepared you are, the easier it is to actually win a bid and get a house. When you put in multiple offers, it's easier for you to figure out ways that you can stand out so you can find a home that you like and actually be able to move into it. You can also make sure that you're comfortable with the loan that you're getting. You're comfortable with the budget that you're setting aside. Buying a home should be an enjoyable process. It's a tough process, but it should be an enjoyable process. There should be an element of fun, lightness, of joy in it as well. For me, it was actually the sale of a home that got me into the real estate business. I enjoyed it that much. And the more that you know, the more that you're prepared for, the more that you understand how to navigate some of the hurdles by watching videos like this, the easier it's going to be moving forward. So for now, this is Tom Olsewski with Team Olsewski signing out. Remember, it's important who you work with, and we would love to work with you.